focusing first on Equitas Small Finance Bank and Alembic Pharma. Now, we had a chance to interact with Equitas Small Finance Bank, the management, and the stock is up quite a bit. So, Abhishek is here to tell us what were the key takeaways from the conversation and as well as the stock performance. Abhishek, you heard the management, optimistic views coming in from them, but you tell us.
Well, they did sound optimistic. So to start with the numbers, they were a beat on our poll with best ever return ratios or ROA that they have recorded. So one key negative factor that I see is that the tenure of the book is increasing. Disbursal to AUM ratio is now about 50%. 2 quarter back, it was about 28.5%. So more of, interest payment is happening in the EMI proportion than the principal payment. So NII growth is robust at 28% YOY and about 9% sequentially. Other income pretty robust at 61% growth YOY and about 56% sequentially. So the profit growth was really on the stronger side, coming in at 59% YOY and about 11.7% sequentially. If you take a look at the net interest margin, it has expanded on a sequential basis by about 10 basis points, which has helped the ROA being the best ever in a quarterly performance that Equitas has given at about 2.28%. ROE also improved both YOY and quarter-on-quarter, and asset quality has come down. So gross NPA ratio now at 2.76% when compared to 3.63% in the previous quarter. So in terms of P&L performance, both the NII and PAT is a beat on our poll. We did have the management earlier. They said that they can maintain the 25 to 30% kind of a loan growth on a YOY basis over the next couple of years. So the net interest margin can come down a bit over the next few years. They have said that they'll launch some high-yielding products like personal loans in H2 of FY24. So they expect the net interest margin to be at and above 8.5% range. They expect the credit cost for FY24 to come down to pre-COVID levels, and they expect credit cost of around 1.2% for FY24. Back to you.
Okay, all right, Abhishek. Thanks very much for that. In fact, let's listen in to the Managing Director and the Chief Executive Officer of the company on their Q4 performance.
We believe that this 25 to 30 is something that we should be able to maintain over the next few years. The NIM will be actually a factor of the kind of product mix that we have. So currently we have a product mix which yields the current NIM that we have. The new products that we are looking at, like a personal loan or a credit card, etc. I know they are going to take some time. They are probably the personal loan should get launched in the second half of this year. And so they're not, we are not really introducing too many new products in a short time frame, which may have a lower yield. So I think this 2 to 3 year, 8.5 is a decent number to look at. Last year, FY23, we had guided for a 1.5% credit cost, and we ended up the year at just about that 1.5% level. This year, we predict credit cost, which should be more closer to our pre-COVID level, because our GNPA, last year we started with a GNPA of over 4% last financial year. But this year we are starting with a GNPA of 2.6%, which is actually the same as our pre-COVID levels. So our GNPA has come down to the pre-COVID level. So we expect the credit cost also to come back to the pre-COVID level. And pre-COVID, our credit cost used to be around that 1.2, 1.25% level.
Okay, so that's Equitas.